Dollar cost averaging sounds almost too simple to be taken seriously. Invest the same amount of money at regular intervals, regardless of market conditions. No forecasts, no timing, no drama. To beginners, it feels basic. To skeptics, it feels naive. And yet, when financial celebrities reflect on how wealth was actually built, not imagined, but endured, this quiet strategy appears again and again, not as a trick for beating markets, but as a structure for surviving them. The appeal of dollar cost averaging is often misunderstood. People think it exists to maximize returns. In truth, its real power lies elsewhere. It exists to neutralize the most dangerous variable in investing, the investor. Markets fluctuate. That is unavoidable. But behavior fluctuates even more. Dollar cost averaging was designed not to outsmart volatility, but to make volatility irrelevant to decision making. Most investors enter markets emotionally synchronized with headlines. They invest more when confidence is high and pull back when fear dominates. This instinct feels protective, but it is destructive. Financial celebrities learn this lesson early, often after paying tuition in losses. Dollar cost averaging flips the script. It forces consistency when emotion demands reaction. It replaces timing with rhythm. One of the most important insights from books on long-term investing is that the biggest risk for most people is not buying at the wrong price. It is failing to stay invested long enough. Dollar cost averaging directly addresses this. By committing to regular investment, it removes the psychological burden of deciding when. There is no moment to get right. There is only a habit to maintain. Financial celebrities often describe their early investing years as fragile. Income was uneven. Confidence was untested. Market drops felt personal. Dollar cost averaging provided structure during this instability. It created progress without requiring courage. Even during downturns, investment continued not because optimism was high, but because the system demanded it. Another misunderstanding is that dollar cost averaging is only for beginners. In reality, its value increases with scale. As portfolios grow, the emotional cost of decision-making rises. A wrong move feels heavier. Regret sharpens. Financial celebrities with large capital pools often use forms of dollar cost averaging precisely because it protects judgment. It prevents overcommitment during euphoria and paralysis during fear. Dollar cost averaging also reframes volatility itself. Price declines become opportunities to accumulate more units with the same capital. Price increases slow accumulation but confirm progress. This reframing transforms market movement from threat into process. Financial celebrities learn to welcome volatility not because they enjoyed risk, but because volatility combined with consistency works in their favor over time. Another crucial benefit is humility. Dollar cost averaging admits ignorance. It does not pretend to know where markets are going next week or next year. Financial celebrities embrace this humility. They understood that forecasting is seductive but unreliable. By investing steadily, they accepted uncertainty instead of fighting it. This strategy also aligns naturally with human cash flow. Most people earn money periodically. Dollar cost averaging matches income rhythm with investment rhythm. This alignment reduces friction. Investing becomes part of life, not a special event requiring confidence or conviction. Financial celebrities often emphasize that what fits life lasts longer than what looks optimal on paper. There is also a subtle compounding effect at work, not just financial, but behavioral. Each investment reinforces identity. You become someone who invests consistently. Over time, this identity matters more than any single return. Financial celebrities often say that wealth was built less by brilliant decisions than by unbroken habits maintained over decades. Critics of dollar cost averaging often point out that lump sum investing can outperform when markets rise steadily. This is mathematically true. But financial celebrities rarely optimize for best-case scenarios. They optimize for survivability. Dollar cost averaging sacrifices some upside in exchange for dramatically reduced downside of behavioral error. Over long careers, this trade-off proved favorable. Another overlooked advantage is that dollar cost averaging creates emotional distance from price. When investment is automatic, price becomes less personal. There is no sense of having chosen wrong. Financial celebrities valued this detachment. It preserved mental energy and prevented self-blame, both of which corrode long-term discipline. Dollar cost averaging also interacts powerfully with time horizon. The longer the horizon, the more effective the strategy becomes. Short-term fluctuations average out. the market's long-term upward bias asserts itself. Financial celebrities who started early and stayed consistent often found that simplicity outperformed sophistication. Importantly, dollar cost averaging is not about passivity. It is about commitment. You commit capital regularly. You commit to staying invested through discomfort. You commit to ignoring noise. This commitment is active discipline disguised as simplicity. Another insight from experienced investors is that dollar cost averaging works best when paired with diversification. Broad exposure reduces the risk of concentrating purchases into permanently impaired assets. Financial celebrities often combined dollar cost averaging with diversified funds or high-quality businesses, ensuring that consistency fed compounding rather than entrenching mistakes. Over time, dollar cost averaging also changes how investors experience market crashes. Crashes no longer signal failure, they signal acceleration of accumulation. Financial celebrities describe moments of quiet gratitude during downturns, not because losses felt good, but because the system continued working without requiring courage. There is also an ethical dimension rarely discussed. Dollar cost averaging discourages speculation. It reduces temptation to chase fads. It aligns investing with long-term ownership rather than short-term extraction. Financial celebrities who valued sustainability often gravitated toward it for this reason alone. As portfolios mature, dollar cost averaging often evolves rather than disappears. Contributions may slow, rebalancing takes precedence, but the underlying philosophy remains: consistency beats cleverness. Financial celebrities retain this mindset even when no longer contributing actively, applying it to reinvestment, deployment, and risk management. And this is where the story begins to narrow. Because once dollar cost averaging is understood not as a beginner's tactic but as a lifelong behavioral framework, its true strength becomes visible. It does not promise extraordinary returns. It promises endurance. It does not require prediction. It requires faith in process. And in a world where most investors fail not from lack of intelligence but from lack of consistency, this quiet strategy becomes one of the most powerful tools available, shaping outcomes not through brilliance, but through repetition, patience, and the willingness to keep going when emotion insists you should stop, unfolding steadily across years, market cycles, and personal doubt, like a metronome that keeps time when the music becomes chaotic. And this is where dollar cost averaging completes its quiet argument, not by dazzling with results in any single year, but by proving itself across decades when consistency becomes rare and emotion becomes expensive. In the second half of this lesson, financial celebrities stop describing dollar cost averaging as a strategy and start describing it as a behavioral contract. A contract with yourself that says, I will not let mood, headlines, or recent performance decide whether I show up. I will show up because I decided to long before today's feelings entered the conversation. The most powerful transformation happens when investors realize that dollar cost averaging eliminates the need for courage at precisely the wrong moments. During market crashes, courage is demanded when fear is highest. During bubbles, restraint is demanded when greed is loudest. Dollar cost averaging bypasses both tests. It does not ask how you feel, it executes anyway. Financial celebrities valued this deeply because they knew their weakest moments were emotional, not intellectual. Over time, this consistency compounds in unexpected ways, not just in account balances, but in confidence. Investors who stick with dollar cost averaging develop a calm relationship with markets. Drops no longer feel like personal failure. Rallies no longer feel like validation. The market becomes a partner in a long process rather than a judge of daily worth. This emotional neutrality is one of the rarest and most valuable outcomes in investing. Another critical insight is that dollar cost averaging protects against decision clustering. Many investors make their biggest commitments at the same time near market tops, because that is when confidence is highest. Dollar cost averaging spreads commitment across time, reducing exposure to bad luck. Financial celebrities understood that spreading decisions is often more important than perfecting any single one. As years pass, dollar cost averaging also becomes a shield against regret. There is no single entry point to obsess over, no haunting if only moment. Financial celebrities often describe peace of mind as one of the greatest returns this strategy delivered. Regret drains energy. Energy preserved compounds elsewhere. Eventually, investors notice a subtle shift in identity. They stop seeing themselves as market participants, reacting to prices, and start seeing themselves as owners steadily acquiring assets. Ownership thinking changes everything. Owners care less about short-term quotations and more about long-term productivity. Dollar cost averaging accelerates this mindset shift quietly but decisively. Another important evolution is how dollar cost averaging interacts with adversity, job loss, illness, life disruption. Because the strategy is built around affordability and regularity, it can be paused without collapse and resumed without drama. Financial celebrities valued this flexibility. Strategies that require perfect continuity often fail at the first real test of life. Critically, dollar cost averaging also teaches respect for time. It acknowledges that wealth is rarely the result of a single brilliant moment. It is the result of many ordinary decisions made repeatedly without interruption. Financial celebrities who started early often credit time, not insight, as the decisive factor. Dollar cost averaging simply ensures that time is used. As portfolios mature, the role of dollar cost averaging evolves. Contributions may stop, but the philosophy remains. Dividends are reinvested steadily, capital is deployed gradually. Even selling is often staged rather than abrupt. The rhythm persists. Consistency outlives accumulation, and so the lesson resolves into a truth that feels almost uncomfortable in a culture obsessed with optimization. Dollar cost averaging does not make you exceptional. It makes you reliable. It does not guarantee the highest return. It dramatically increases the probability of finishing the journey intact. Financial celebrities understood that finishing matters more than winning early. If this reflection resonated with you, pause and ask yourself one question. If markets became chaotic for the next 5 years, would your investment process still function without requiring courage every month? Dollar cost averaging exists to answer yes to that question. Share your thoughts. And if you want to keep learning how the simplest disciplines quietly outperform clever strategies over a lifetime, stay connected. Subscribe, follow, and return. Because in investing, the strategies that feel boring are often the ones still standing when excitement has exhausted itself.